Good morning, everybody, and welcome to this panel debate on rating regulatory reform. We're looking at the question of whether regulatory reform has worked, and if it hasn't, what needs to be done. My name's Gillian Tett. I'm the US Managing Editor of the Financial Times newspaper, but until quite recently, I was in charge of running the financial coverage for the FT, and I used to write at length about the markets back in 2005, 6, 7. And back then, I used to say to my colleagues, I couldn't imagine anything worse than trying to explain the terrible complexities of the modern credit world, or the CDOs and SIVs and things like that, to FT readers. Well, since 2007, 2008, I have discovered there is something worse. It's trying to explain all the regulatory responses to the complexities of the modern financial system to FT readers. Because what we're facing today is very much a world of complexity cubed, not CDO cubed, but complexity cubed, where we have complex financial flows, complex reform processes, and even more complex, if not contradictory, reform goals. So here to discuss these issues is a terrific panel that I'm going to introduce in just a second. But before I do, I've been instructed to say a few housekeeping points. Firstly, please switch off your mobile phones. Secondly, you will see on your seats a little device here, which is a digi-voting machine, which can do two things. Firstly, it can enable us to do an audience poll on several key questions. But secondly, it can also enable you to send me questions from the audience to pose to the panelists. There won't be any floor mics, floor questions. So if you want to ask a question, and I would encourage you all to ask as many questions as possible, use this, and it then appears on the iPad in front of me, and I can then pose it. And with the questions, it would be courteous, but not compulsory, to identify yourself. And if you want to indicate it to whom it should be asked, please do so. Right, well, I think that's the housekeeping issues out the way. So let me introduce this fantastic panel to talk about regulatory reform. And what we have on this panel, which is very exciting, is not only people from the buy side and the sell side, we also have a wealth of people who have got good regulatory experience, but also private sector experience as well. So starting on my immediate right, your left, we've got Barbara Novick, who's the vice chairman of BlackRock, been at BlackRock for a quarter of a century, and currently looks after government relations, and so is very experienced from the buy side at looking at the regulatory issues. Next to her, we have Commissioner Nazareth, Annette Nazareth, again, I think known to most of you, who was at the SEC for a decade and is now working on the private sector as a partner for Davis Polk. Next to her is Elizabeth McCall, who is currently partner in charge of the New York office of Promontory Group, but previously was the superintendent in charge of banking of New York City. And on the far end, on my far right, your left, is Sylvie Matera, who was previously with the Banque de France for a number of years. Most importantly, since 2007, was working on the international coordination aspect, dealing with the G20 and trying to bring some coordination to international regulation, but is now working with Deutsche Bank, where she's been for 3 months on the board, the executive board, and importantly, she represents the first time that Deutsche Bank has put somebody in charge of regulation and government affairs actually on the board, which is a very powerful symbol of how seriously the financial industry is taking regulatory issues and needs to take regulatory issues. Now, this time last year, this particular session did a poll of the audience which asked, do you think the financial system is effectively safe or not, and is the financial system heading for another crisis in the future? In other words, do we think that this tsunami of regulation that we've seen has actually prevented the risk of another financial crisis? Now, I don't know how many of you know the results of that question. I will be asking it again right at the very end of the session. But this time last year, somewhat astonishingly, 2/3 of the audience, in fact, over 2/3 of the audience, thought that the system was heading for another financial crisis. One way to read that is that 2/3 of the audience thought that the wise regulators, including those represented here, had not done enough to make the system bulletproof. So I'd like to start off by asking you each in turn, perhaps starting with Barbara, since you're the one person who's not been a regulator on this panel. How do you assess the regulations that have happened so far? Do you think that net, what we've seen since 2008 has been a good thing?
So I think in framing the question, it's not a question about did we go too far or not far enough. I think it's really a question about are we regulating the right things. So if you look at, there's an alphabet soup of regulation. It covers all sorts of things. But what we have been advocating is the need to look at products and practices as opposed to looking at firms and funds. And that the horizontal approach would actually address many of the risks that the regulators have, whereas the targeted approach would miss the point entirely.
Right. So basically you're arguing, don't look at firms, look at financial processes, effectively.
Products and practices.
Products and practices, right.
And that would be true in insurance as well as in asset management.
Okay. What about you, Commissioner?
Well, I think we are, I do think we're in a better place than we were before. I think we have focused on many of the issues that are important to focus on. I think it's hard to imagine today, given how far we've come even in the last few years, that we had markets that, for instance, derivative markets that weren't regulated. It seems quite surprising that we had come as far as we had with a market that was a multi-trillion-dollar market that was essentially unregulated. I agree with what's been said. I do think that one of the problems that we have, we do now, I think, have a better perspective on products, better perspective on activities. I think, unfortunately, we have not solved the problem of regulatory structure. And I used to think that perhaps it didn't matter that much, that you could sort of make up for the flaws in the structure of regulation by just sort of working together. And I'm sure others here will have views on this as well. But the notion of this sort of plethora of regulators that we have who are supposed to coordinate makes it very difficult. I think there are still possibilities that things will fall between the cracks. And frankly, one of the major problems, or certainly in the U.S., one of the major missed opportunities with Dodd-Frank was that we missed the opportunity to rationalize the regulatory structure. We ended up with at least as many, if not perhaps more, regulators than we did before. And I think we're seeing some of the growing pains of the continuous emphasis on trying to coordinate among regulators. And of course, now we have to do it on the international side as well.
Okay, so you want products and processes to be focused on. You want consolidation. Yes. Would you like to merge the SEC and CFTC, for example, to start?
In a second.
And who else would you like to merge with? Would you like to take over the OCC as well while you're at it and knock out?
Well, I think,
the banking superintendents in New York, the state-level superintendents?
Under two different administrations, Republican and Democratic, there were white papers by Treasury departments that talked about consolidation and serious consolidation. Of course, at that point, we were into sort of UK envy. We were thinking about, having, either a single regulator or a dual system where you had, the monetary authority as one and the supervisory entity as another. But and maybe we wouldn't be able to consolidate to that extent. But even starting incrementally with the SEC and CFTC would have made me happy.
I'm kind of guessing you probably would have liked the CFTC to be a kind of a branch of the SEC and not the other way around.
I think that's the problem, is that I think we could have called it a cupcake. It didn't matter. I think we had to put aside the historical differences and just find a new way to deal with what are essentially the same product.
I think it kind of matters to the CFTC staff, but
yes.
And it also matters to many of the state-level regulatory groups, like the one that you yourself used to run. Yeah. Do you think it's time to merge together all the regulatory organizations and abolish the state-level regulators in favor of a federal structure?
I like to think it's not just a matter of your own history that leads you to an answer to a question like that. But I remain in favor of some regulatory discourse and some check and balance in the overall regulatory construct. I completely agree with the Commissioner that there's certainly plenty of room for gaps in the regulatory system, the way that it's currently configured, and having some more coordination and consolidation is absolutely necessary, because we all know, you asked, how do you assess the progress of the regulatory process so far? And, we all have to agree that there's been a tsunami of regulations that have come across. The complexity is mind-boggling. And the risk for gaps in the regulatory oversight because of the alphabet soup of regulatory authorities is certainly there. So I would generally be in favor of much more coordination. I think we're seeing it, especially internationally, and I don't think it's just based on relationships, which is where it was when I was in office as superintendent. I think you see a much more coherent global approach. But having some more coordination, probably beyond the FSOC, would be a good thing.
Right. Well, I'm going to come back to that. But first of all, Sylvie, from your perspective, since you were previously in the public sector and you're now in the private sector, which is something which is a bit less usual in the European context, do you think the regulations that have been introduced since 2007 have made the system safer? Or do you think the complexity is potentially creating more arbitrage opportunities?
Well, I certainly think that what has been done since 2007 was really needed, and that we end up, as you said, in a more safer world now than it was in 2007. But at the same time, I guess the work is not finished from my point of view. Not meaning that we need more regulation, but there is something that is needed. Clearly, the regulation was made in silo in a way, because we had to address the exact problem.
In silos,
then,
yes.
Yeah, then when you add everything together, you need to be sure that everything fits together, and that there is something that has to be done, is to check the interaction between all those different regulations, because in the end, they apply to the same institutions, and I'm very well placed now to see all those regulations coming, and having to put that in place at the same time in the same organization is very tricky. So there is two things that the public sector has yet to do, is first to check all the interaction between all those regulations, to see whether all the incentives go into the same direction. That's very important, that you don't have certain regulations that contradict each other. That's the first work that has to be done. And the second one is just to look at the global impact on the economy, because we shouldn't lose the goal. The final objective of all that is not only to make the world safer, but also to make sure that banks finance the real economy. And clearly, the final thing that has to be done is to look at the global impact on the economy of all those new regulations.
Right. I mean, looking at the complexity and the extraordinary wave of regulations, I'm curious to know where you think we are in the process in terms of, are we almost at the end of the regulatory wave, or are we only halfway through? Because if you take a long historical perspective and go back to the 1929 crash, Glass-Steagall came in 1933. So you basically had a 4-year lag, which more or less mirrors what's happened in terms of the wave of regulations that came in this time round with Dodd-Frank. And yet, most of the regulatory initiatives had sort of stopped. They didn't have new waves of regulation by the mid to late 30s, which would imply, if we're repeating that history, that we've actually had most of the regulatory response to 2008. I mean, Sylvie, are you working on the assumption that you're basically dealing with this massive wave of regulation and that's pretty much it? Or are you expecting a new wave of regulation to come?
No, I guess I think we're nearly done, and now the exciting part will be on the implementation side. That's certainly one of the reasons for my move.
Right, the exciting part, that's good.
So, no, I think it's because if you look at the objective, what was the objective after that crisis? In fact, it was two main objectives. The first one is to try to avoid a repetition of what happened. Never again. So for that, try to reduce, in a way, the probability of default of the large international bank or the large banks. So that's done with Basel III. I mean, we increase the level of capital, liquidity, reduce the leverage, everything. Then the second goal is, well, if we don't manage to get the first thing right, if there is still some failure, then we need to avoid at all price to go to taxpayer to finance that. And so in order to do that, you have the second wave of regulation, which came, I would say, after 2009, which deal with the type of resolution issues, how to make sure that those big organizations being able to resolve themselves without having needed to have recourse to the taxpayer. And so that's the second wave we are dealing with right now, which is quite complex and may have some impact on some bank business model, which is something we may need to discuss. But we are nearly there. And I'm feeling now that the most important thing to do is now to try to implement it in a nice way, in a holistic view, in order to be sure that everything that has been decided is really implemented.
Right. I mean, Barbara, sitting from the private sector end of things, are you assuming that most of the worst is over, or are you bracing yourself for a new wave of radical money market reforms, for example?
So the analogy,
or money market fund reforms?
Right. The analogy I would use is we've just climbed the highest peak mountain in the world. We still have to get down. And there's going to be a lot of switchbacks. There's going to be a lot of boulders. There's going to be a lot of technical things on the way down. So it's not done. But certainly when you're standing at the top and you're looking out, and you can start assessing, well, what are the gaps, if any? I would say I'm less concerned about gaps than I am about conflicting regulations, over-regulation. We have things where we report the same information to multiple agencies, both within country and then across country. So the needs for harmonization of even just data collection. It's very important to be able to turn data into information. Raw data is useless. Having data collected different ways in different jurisdictions makes it something you can't aggregate, you can't study, you can't really get any information out of it. So there's a lot of opportunity to clean up and rationalize some of what's been done. I think you see the most extreme in the shadow banking area. It's a very pejorative term. Think about market finance. So there was a huge effort to eliminate shadow banking. But what fell in shadow banking? Money market funds, securities lending, securitization. You go to Europe today, and the conversation is about the need to diversify away from the banking system, because if the banks aren't going to lend, where is the capital going to come from? And surprise, shadow banking is no longer the topic. Now it's how can we harness securitization to be a growth engine for these economies? How can we regulate it properly so it can be used as a good tool, not a bad tool? So that kind of brings me back to what I said earlier, is you have to look at the products, both the products themselves and then how they're being used, regulate them appropriately so you get the good features and you limit the downside.
Right. Annette, as someone who's sat inside the SEC, I mean, if you look back at the history of the SEC and other agencies, you can see these cycles where you have this intense burst of rulemaking, and then you basically stop. Are you assuming that the intense burst has basically come to a halt, and the next decade will be about implementation and interpretation, or enforcement, which I will come to in a minute?
Actually, it may sound odd to say because we are all suffering from regulatory fatigue, but I would hope that it doesn't stop, because I think you do need fine-tuning. I think what we have found in many instances is that you have regulation, it's episodic. You have regulation that results from a crisis. It's not perfectly fine-tuned, it's somewhat reactive. And then as circumstances improve, there's a sense that there's over-regulation, and therefore we should have no regulation. It's impeding competition or whatever. And so you get these ebbs and flows where, in fact, if you had regulators who more consistently, I think, really looked at the impacts, how effective it is, and talked about, certain fine-tuning, I think you'd be in much better shape. As to your question about where we are, as you know, at Davis Polk, we do the the progress report, the monthly progress report, and numbers sometimes lie because for Dodd-Frank, what we're showing is that we're about 60% through the process of adopting final rules that were required under Dodd-Frank. But if you look at what's actually been done, the really big, hard, areas, a lot of them have been done. I mean, the SEC's been somewhat slow in finalizing their swaps regulations, but the CFTC is largely done. Volcker, which was a huge effort for the bank regulators, has been adopted and is being implemented. So we've made a lot of progress, but that really only looks to the things that were mandated after the crisis. I mean, we're going to continue to have issues like market structure issues or money market funds issues and the like that, should be reviewed and continuously updated, and that's going to continue.
And since you live in Washington, before I go to Elizabeth, since you live in Washington, and if you were a betting person today, what odds, what probability would you assign to the prospect that the Republicans will succeed in rolling back some of the Dodd-Frank provisions, or the Volcker provisions? Are you expecting to see the pendulum swing back and a lot of these rules to be ripped up?
No, not at all. I don't think we're expecting to see any changes at all in the next few years. And in fact, I think, wholesale repeal and that kind of thing is sort of out of the question. Unfortunately, what you're also not going to see is the kind of modest fine-tuning that is very much required and that I think everyone thought would happen after Dodd-Frank was adopted. And the reason is that the Democrats are afraid to open it up at all for fear that even small technical corrections will open the floodgates to further repeal efforts. And so you're getting just a total standstill with the regulators trying to deal with it in their own way.
So basically, what's on the table, no matter how incredibly flawed, contradictory, and lacking in coordination, is kind of basically what you've got.
It's what we've got.
Okay, well, that will maybe good news for lawyers, but bad news for everyone else. But Elizabeth, I mean, I'm going to ask you, not with your superintendent hat on, but with your promontory hat on, looking at the broad sweep of regulation out there, are you telling your clients that what you've got on the table is what's going to last? Or are you preparing some of them for fine-tuning or for even a rollback going forward?
I have to agree with the commissioner that I don't think we're expecting any sort of a rollback. On the other hand, and I do always root my thinking in the regulatory process, you see a very thoughtful group of regulators, not only in the United States, but globally. And I have every expectation that history from the Depression era is not going to be repeated, where the regulations were set and adopted and final in a 4-year period of time. You have a massive change that's taken place. Think about stress testing, for example. Think about resolution planning. These are tools that are brand new. They're just being road tested, and I have every expectation that the regulators are going to be very thoughtful in looking at the output of these new tools, domestically and internationally, and make some decisions about what works, what can be improved, how do we make the results link more closely to preventing systemic risk, and that will result in some changes.
Right. Well, I'm going to ask you each in a moment to talk about the thorny issue of enforcement. But before we do that, I just want to ask you quickly, I mean, if this was American Idol, with all this lurid green and purple, and you were voting on your favorite top pick of all the rules that have been introduced, what do you love most out of everything that's been introduced? Elizabeth?
Culture, risk culture. And that's a new, it's legislative, it's regulatory, and it's global. Everywhere from Canada to Australia, you have now a term in regulation that those of us that grew up in regulation would say, exactly what is that, and how can we be objective about thinking about it? But I think it's absolutely my favorite one because I think it links to some of the root cause.
So the fact that people are actually talking about culture Okay, well, as someone who trained as an anthropologist, not an economist, I love that, but I'm totally biased. Sylvie, what about you?
Well, I guess the most useful one, and which was really needed, was the one on liquidity. I mean, clearly we focused, the regulators focused in the older times on capital, and the crisis showed that clearly liquidity as a price, and liquidity shouldn't be taken as a given. You don't die out of loss of capital. You die because you don't have liquidity to do your business, and that was really deeply needed.
Right. Annette?
Well, I referred before, I think my clients would be shocked to hear me say this because the implementation and a lot of the way the derivatives market is being regulated was a little overly broad, to say the least. But I do think that as a topic area, the derivatives markets, and as a product, needed to be regulated. So I think that was very important.
That's kind of herogram to the CFTC then.
Yes.
All right. And Barbara?
We were also early supporters of central clearing. We think that that's a good idea. I'm going to say with a but, because there's some very unfinished business in that area. We've now created these essentially utilities, and unlike the banks that have capital requirements and stress testing and transparency, the oversight of the CCPs is not sufficient. They don't have sufficient capital. They're not doing stress testing. They're not resilient enough to not be the next crisis. So I'd say great idea. Implementation still needs some work.
Right. What about the issue which perhaps as far as the public was concerned was the area where they wanted to see action, which is basically enforcement and punishment? I mean, one of the huge ironies of the world since 2007 and 2008 is that there has been a lot of enforcement, but quite a lot of it has not been directly related to the crisis. There's been enforcement in other areas, be it the FX, the LIBOR scandals and things like that. While you're collecting your thoughts, I'd like to hear certainly from some of you about what you think about the enforcement. We actually have the ability to ask you in the audience what you think about enforcement. This is a question guaranteed to make all of you wake up, particularly if you're a lawyer or dealing with enforcement at your own company. And the question I'd like to ask you all is, if you look at what's happened with enforcement over the last year and the spate of stories in papers like the Financial Times and others, and the way that firms have been fined, do you think that the fines are excessive or not? If you think that the fines for transgressions should be higher, i.e. you should have even more billions being collected, vote 1. If you think the fines are correct, vote 2. And if you think the fines are far too high and you think that bankers and other finances should not be facing such punishments, vote 3. I am conscious we're not sitting with an audience of entirely neutral turkeys voting for Christmas, but let's see how we go. Well, that is somewhat contradictory. Who would like to? Annette, would you like to comment on that from the former SEC's perspective? Do you think the fines should be higher, or do you think they are about right?
I don't know how I could possibly answer that question. I think I'm as conflicted as the audience is on this. I think it very much depends on the case and the facts. I do think we've had some really staggering numbers in some of these enforcement actions, but and I think they have certainly been some cause for concern. But hopefully they're not the rule.
I mean, I was chatting to some of your former colleagues at a conference recently, who were saying things like, "Well, if you'd asked us," and these are former regulators, if you'd asked us, say 5-6 years ago, to guess the total level of enforcement fines, it probably would have been 1/10 of where we are today. Is that what you would roughly agree with? I think the total, according to London School of Economics study, is about $200 billion in terms of what's been collected, I think what will be collected by the end of this year. And people were thinking it should have been, in their expectations, nearer to 20 billion. Is that roughly where you sit?
I don't know if that's exactly the number I would give, but I do think that it's multitudes of what I expected from some of those firms. The numbers in the billions are really quite staggering.
And do you think that's because the firms have indeed been found to do things which are so much worse than you expected? Or do you think it's because the regulators have got so much tougher, or is that political pressure?
I think it's a combination. I definitely think there's political pressure. And I think, unfortunately, there's sometimes a piling on of the regulators. I mean, the problem is it's not just one regulator, it's a series of regulators, each of whom has to show that they collected as a result of the wrongdoing.
So kind of regulatory inflation?
Yes.
Or free market competition in another
That's
form?
right.
Right. Elizabeth, as somebody who was previously sitting in one of the agencies, which is obviously engaged in this kind of political competition, are you surprised by how big the enforcement number has become?
I think I probably speak for many in the audience when I would say that I think we're surprised by how high the enforcement has come. But you know, I was a regulator that used enforcement tools in particular cases when necessary, and often with very large amounts, depending on the facts in the case. So enforcement is a wonderful tool for regulators to have at their disposal. But enforcement is not the only tool, and we don't want to lose sight of the fact that enforcement has to have also the regulatory relationship aspect where you can work with the regulators and understand what's needed to make the changes that are in place. And so, you know, I hope that we continue to see that aspect of enforcement, not just numbers.
And would you expect, I'd like to ask either of you who wants to answer this question, and you may not rush, but do you expect to see the enforcement fines increasing in future? Because, of course, I mean, leaving aside the details of the fact we have the FX potential settlements coming through, but do you expect to see this to keep snowballing?
I do. I think that we're in an environment where regulatory enforcement with very large fines attached to them is the reality. And so, you know, the expectation on the part of the regulators is that these actions with these high fines will act as a deterrent. And I'm sure that institutions are paying close attention to that aspect and working hard to put remediation and those types of things in place.
Right.
I think it's episodic. I think it will get worse before it gets better. But I think when they get to be really too high, then you get some pushback that with the questions of who are you really punishing? Are you punishing the shareholders, or are you punishing the wrongdoers?
I mean, Barbara, sitting from the buy-side perspective, which for the moment has escaped most of these regulatory penalties, I mean, do you feel sorry for the bankers right now? Do you think that they deserve this?
Okay, so first thing is, I think some of the behavior that we've seen is just reprehensible. Certainly points out that there's a tremendous need for an ethics class, not just at business school, but somewhere along the line, and that needs to be reinforced regularly. That said, I asked somebody for this conference to give me a list of the settlements. And the numbers that I added up on just U.S. fines against U.S. banks is over $70 billion. The numbers for non-U.S. banks operating in the U.S. is close to $20 billion. And as you've just heard, we're not done yet. So as a buy-side participant, as an investor in these companies, who is being harmed? Is that going to change behavior, or is that a cost of the company that comes out of the shareholders? I think at some point you create disincentives. You create, for the foreign banks, disincentives to be located in the United States. That has a jobs impact, that has a market-making impact, that has a lending impact. So we have to find the right spot, and you know, these things do tend to be pendulums that swing too far one way, too far the other way. I'm worried about what you said and what you echoed, that there's almost like a regulatory race, who can be the tougher regulator. The other thing is you have to look at what's behind these numbers. So I'm going to say, when you look at the mortgage settlements, which have been some of the biggest numbers, every one of those settlements has what's called homeowner relief. And it looks like the bank has agreed to a very high settlement. But unfortunately, homeowner relief actually comes from investors' portfolios, not from the bank. The bank gets credit towards their settlement for modifying mortgages that they don't even own. It's not well understood, technical detail, under the radar, but as investors, we question the size of the settlements and who's actually paying for it. Big headline, but actually the money coming from investors who had nothing to do with it and are somehow being punished in a settlement that they have no seat at the table for. Very disturbing trend.
Right.
Gillian, if I may, on this one, I mean, it's very difficult for me to discuss on that, but clearly, I guess the degree of tolerance has really changed in the recent months or years, and it's close to zero right now. And at the same time, within banking organization, I mean, there's a huge awareness of a need of a culture change, the one you mentioned as one of your favorite topic. And I guess I feel that, and it's certainly the case in my bank, that we feel the need to improve and to, because at this stage, this awareness about the need of a culture change is at the board level, but it needs to be spread everywhere, even to the last point in the trading floor. And that's something that still has to be done, but that's something which is work in progress.
Right. Well, I guess that leads very naturally to the next question, which I'd like to get the audience to vote on, which is, are any of these fines going to actually work in terms of actually bringing about the culture change that Sylvie and others want to see? So we have another question for the audience. Will enforcement actions be effective in preventing future transgressions? 1 for yes, 2 for no, 3 for impossible to tell. So why don't you go ahead and vote, and we can see whether anyone thinks these fines actually work or not. Oh, right. Well, that certainly should give plenty of encouragement to the regulators. I guess it would be nice to ask whether, in fact, whether individuals were put in prison would have more impact than fines, but I don't think we have that ability. Do any of you have a view? Would you rather, any of you rather see more bankers actually individually going to jail rather than companies paying fines, or do you think fines are the answers?
I think the answer is in the area of risk culture and the regulatory focus on that aspect, and it is just beginning. You don't have programs that are yet built out. It's about taking an ethics class and things like that, but I think that what we need is a true framework that's in place to manage risk culture, where you have measurement, you have monitoring, you have definition, you have all of the things that go along with traditional risk management, but with this focus on culture, and that it needs to be not a soft discipline, but a hard discipline where you have quantifiable results that bring about the changes that these enforcement actions are aimed at.
Right, right. I mean, on that note, I'd just like to switch the debate a little bit and ask, when you look at the plethora of regulations that have been introduced, do any of you have a favorite hit list of a regulation that's been introduced that you think has made things worse? Anything you'd like to abolish if you had a magic wand?
Well, not abolish, but I mean, there's clearly a set of regulation which has a huge impact on the way banks do their business and on the business model. And clearly, I can pretty much understand that you want to, if you are a public entity, you want to be sure that you try to avoid that resolution as a huge cost for the society. And you try to do everything you can in order that banks can be resolved safely. But then I wouldn't like to end in a world where you can die very easily, but you're not allowed to live very well. Because in fact, you need some of the things that you need to do as a bank, for example, to diversify the risk. If you look at it from a bank perspective, it's risk diversification. But if you look at the same type of issue from a regulatory perspective, it may be contingent risk. So you have to find a balance there. And which the regulation I don't like that much is the one who formalize ring fencing in a way. I mean, saying that we're going to protect your operation in certain area of the world, or you're going to protect certain type of operation, for example, retail depositors. But then at the same time, you prevent banks from managing their risk safely because you need to have a certain type of risk diversification. And those type of regulations are really a strong impact on the universal bank market model, for example. And clearly in Europe, we do have universal bank model, and I think it's quite a safe one. It's just the financial traduction of the very public say that is you don't want to put all your eggs in the same basket. I mean, that's universal banking. When investment banking is not going that well, you still have the retail is doing well, and vice versa. So that's clearly something that is very interesting from a risk management point of view. And if you have to ring fence everything, you're not going to be able to manage your own institution properly, and you'll be certainly able to die in a very easier way, but maybe not to live. So the one I don't like is clearly those who promote ring fencing and separation between activities.
Right. Barbara, what do you hate?
I would actually pick two things, and I think Elizabeth hit it on the nose before. The zero tolerance aspect of regulatory reform has led to a very different relationship between the regulators and the regulatees. I think historically there was I want to pick the right words, a closer working relationship. It was a constructive relationship. It didn't mean people were in bed with each other, but there was more of a dialogue. There was more guidance of what worked, what didn't work, and problem solving so that you got it right in the first place and you didn't have a problem later. We've entered a culture on the regulatory side of a gotcha culture. We're going to look for the slightest transgression. We're going to really come down hard to show everyone we're being tough on banks or on financial institutions. I don't think that's a healthy relationship. I think it would be better, again, that pendulum needs to swing back to more of a very ongoing dialogue, much more ability to come in and ask for guidance, and vice versa. The second would be what I talked about earlier, is this plethora of reporting. I mean, we are reporting information. It's almost like a joke. How many different ways you can report the same information to different entities in the same country and in multiple countries. It is extremely wasteful in resources, but more important is on the receiving end, it's data, not information. To create information, you need more consistency. You need to be able to combine it, aggregate it different ways, slice it, dice it, analyze it. If it's all different and slightly different, it's the least useful data that you can provide, and that's troubling.
Do you have a guesstimate as to how much BlackRock spends on reporting now?
Millions.
Or data aggregation?
Millions.
Well, it'll be a fascinating data point to see across the financial industry as a whole. You know,
it's got to be billions across the industry.
Yeah.
It's fascinating.
Yeah.
And then what would you like to kill off other than the CFTC?
No, I don't want to kill them off. I'd like them to be together. with
Okay.
the SEC. You know, I think there were certainly some things in Dodd-Frank that got added in the end as part of the political process in order to get the bill passed. And so I think, in particular, something like the Lincoln Amendment that basically is what is referred to as the push-out provision that the bank regulators keep themselves pushing out because it is so ill-advised. And was
Can you just
so
remind the audience what the Lincoln Amendment actually does?
It's as I said, it's known as the push-out provisions. It basically says that the banks at a fixed date are going to have to move all of the derivatives out of the banks and into other entities. And I think it clearly doesn't make sense to the bank regulators who thought, well, if it's in the bank, we can see it, we can regulate it. I mean, why are we moving it out? Why are we putting it in places that we may not have as good a window into those activities? And then, of course, you'd have to, logically, they'd move the hedges as well. So you're now encouraging activity that was, was going to be squarely within the view of the regulators to put it in other entities. Apparently, totally politically motivated provision. And then there were other things at the very end, like conflict minerals, regardless of what your views are about things like conflict minerals. I mean, there were certain, whether or not that was appropriate in the financial regulatory reform bill is another question. And those kinds of things can be very, very diverting. That took a huge amount of time for the SEC to address at a time when they really needed to be focused on other things. And so those are the kinds of things that I think were unfortunate.
Fascinating. Elizabeth, what would you like to kill?
I think the word kill off is very
know.
strong. So I can't say that I have one that I'd like
Modify.
to kill off.
Okay, what would you like to
But I have questions.
remove gently from the legislation?
I have questions about the viability of the Volcker rule and how it's currently constructed. And that it's all, the devil is always in the details, the definition about what's proprietary trading and what's there for markets. I think we don't yet know the answer. And this is, going back to what I said before, an area where there continues to be a need for refinement and that type of thing.
Right. Well, I'm delighted to say we have questions pouring in. This is a very, very engaged audience. I've got about 2 dozen questions from what I can see. So let me start with a fairly simple one, which is, what is the chance of getting some form of harmonization in global regulations? Question from the audience, is there any chance of actually getting regulatory rules more harmonized in the future? And I must say, I'm curious to know the answer to this because, when I look at what's been happening the last couple of years in terms of the Volcker rule, in terms of Dodd-Frank, in terms of the European responses, even the British ring-fencing approach, speaking as a journalist, not a legal expert, it seems to me that there's almost as much, if not more, fragmentation in implementation than harmonization. In some ways, it seems to be going backwards, not forwards. But Sylvie, somebody who is actually trying to corral this, a bit like herding cats.
Well, I guess the first answer of the crisis was we need to discuss all that together, and we need to promote harmonization. And in fact, one of the first decisions of the crisis was to make the decision at the G20 level and not even more at the G10. So that makes it more complicated because the G20, for a reason I never understood, we are 27 countries around the table, and making a decision out of 27 countries is hugely difficult. But when you manage to do that, it's fine because at least you have all the main stakeholders around the table. The problem with harmonization is that you have to be very careful with what you intend to do. Do you want to harmonize the rules or do you want to harmonize the results? I guess basically what was needed is to harmonize the results. What we did is what we harmonize the rules. And if your starting point is different, the ending point will be different as soon as you apply the same thing from a starting point that is different. And that's where we are right now. And that's true that we are not yet at an harmonized point, but basically because we didn't take into account the fact that the situation is very different. Take the US and Europe, for example. US banks finance the economy up to less than one third. Europe is exactly the contrary. More than three quarters of the financing is done through banks. If you apply the same constraint to banks, you're going to have an impact on the global economy that will be 3 or 4 times higher in Europe than it is in the US. So that's where we are right now. And I remember once when I was the French negotiator at the Basel Committee table, saying to my US colleague, well, if you want to have the same result, then your capital constraint should be 3 times higher than the one you apply in Europe. And I was thinking I was joking. But in fact, I guess
and what did he say?
That makes sense. If you want to harmonize a result, you have to take into account the starting point. And we didn't do that, and that's why we end up now with something that is quite fragmented. And I'm very afraid that some of the new regulation that we highlight, just that ring fencing, either from type of activities or region, will increase that again.
I'm going to turn to the other 3 Americans in a second. Before I do, I've got another question that just popped up. From one person in the audience. I'll just carry on asking you, Sylvie, because it's a good sequence. Can you please ask the Deutsche Bank person, i.e. yourself, what the European regulatory outlook is? Is it more or less regulation?
For the future?
Yes.
In Europe? Well, it's not more or less. I mean, we are trying to do our best to get harmonization in terms of practices. For example, we are going to have single supervisors in Europe. I guess we are going to have, we didn't finish the regulation in Europe yet because we decided that we have to harmonize within all the European countries, and that's going to take time. And there is a political process that is very specific to Europe that takes time also. I mean, you were speaking at the beginning of the fragmentation of regulators. I mean, we don't have anything to envy the US in that respect. We are trying our best to try to simplify it. It's not easy because people, I mean, it's very difficult. You were mentioning readers of the EFT in your introduction. I mean, but the EFT is a quite sophisticated readers. Imagine the usual people in the street, they just don't understand how we do and how we are regulated and what rules banks have to comply with. So we have to make a big effort in terms of communication in Europe, I guess, but not only in Europe.
Well, as I say, the nightmare really is complexity cubed. You know, complex financial flows, complex reform processes, and complex and contradictory reform goals. It's quite a mess. But I mean, when you look, say, Annette, at someone who was around the table dealing with international regulators, do you think there's chance of meaningful coordination on the world stage?
Well, I think it's incredibly challenging. And unfortunately, the businesses, the banks, are suffering from the fact that there is less coordination, right? They're like the children in a dysfunctional marriage, essentially, where they're being pushed and pulled in all directions. They have to comply with multiple rules that may not always be consistent, and that's really problematic. So I think there's going to have to be some rationalization here. I mean, you know, it's interesting when Sylvia was talking about, you know, is it results or is it, you know, the rules that have to be the same? I mean, one of the other problems that we're seeing is the timing. So we've got situations where, for instance, in the US, the banks are being required to comply with certain rules and are not, you know, they don't have equivalence determinations or substituted compliance for the requirements in Europe because they're not on the same time frame. And so again, that means that these businesses are caught between a rock and a hard place. They're now being told that they have to apply US rules abroad because the European rules aren't completed. And that's just becoming very untenable for financial institutions. And so I think it is going to be incumbent on the regulators to make serious progress here because particularly, not to keep harping on the derivatives market, but you had a market that wasn't regulated, that grew up without regard to national boundaries. And now we're trying to put a genie back in the bottle and saying that national rules apply to this activity across the world. Well, you just can't do that. These relationships were formed years ago, and you're going to have to get some rationalization of the process and some recognition of you know, cross-border equivalence in order for those businesses to be able to survive.
Right. I mean, Elizabeth, I'd like to ask you, with your former hat on as superintendent, I mean, a very common complaint I hear of non-American banks operating in New York is that not only are penalties being imposed on the banks in New York, the non-Americans, but they're being imposed with absolutely no coordination with other regulatory groups, let alone international bodies, and that there's a real anti-American aspect to it coming out. What do you say when people accuse you or accuse your colleagues or successors of that, doing that? Do you think there's need for more coordination? Did you ever coordinate with international regulators when you were in your own supervisory role?
Coordination is the hallmark of very strong supervision and achieving the ends that you want, which is a global change in an institution in terms of its operations, its behavior, its risk-taking activities. So coordination it's at the foundation of it. And I think we just have to recognize, you know, there's been a change in the regulatory environment where it's become very politicized. And so we're on the other side of the mountain, to use my colleague's analogy. So it's a different environment that regulation is now being promulgated, being enforced, et cetera. But at the end, it has to come back to a coherent taking into account all the differences in Europe, in the US, in other parts of the world, some type of a harmonization. Everyone who is a regulator would say that that has to be the objective. You have to achieve that at the end of the day.
Well, while we're talking about sort of cross-border inconsistencies, what about FATCA? Do any of you have the ability to comment on that? Would any of you like to comment on that? Barbara? The actual question is, any comment on FATCA? Do you expect other countries and regions to apply rules that apply extraterritorially?
You know, FATCA was almost like a silent thing. It was a add-on to a bill as a pay-for, right? So the Congressional Budget Office does all this scoring, and they were going to have this, stimulus, and they needed to pay for it. So it was really buried in a set of rules that had nothing to do with taxes, but it was the pay-for. I don't think very many people focused on what the implications of FATCA were when it first came out. We did engage. We had many non-U.S. entities, many of them foreign ministries, quite concerned that the U.S. was exporting a tax system and not doing it in close coordination. The process did change over time. It came up with these intergovernmental agreements. I mean, it definitely softened in certain ways and became more tenable. They did release a lot of technical changes and improvements. That said, I think fundamentally, will it actually serve its purpose of collecting tax of people who are living overseas? I think the burden it's put on expats, their ability to open a bank account, to do basic financial transactions, is really quite burdensome. I'm not sure how much collection there is. The genesis, people were cheating. Nobody wants people to cheat. But I do think it could be in the sledgehammer hitting the fly on the table instead of the fly swatter. And I do worry that other governments are now looking at similar types of things and saying, well, let's use that framework, or let's do the same thing so that we can go collect from expats. I think it's more expense than revenue.
Sylvie, do you have a view on FATCA? Because I would imagine from where you're sitting today, that must have been a big issue in your in tray of issues to deal with.
Well, first of all the implementation of all those type of rules is very difficult. You have global rules that have national implementation and national rules that have global remit. That's clearly the case of this one. So, of course, it's really very difficult to tackle with those type of extraterritorial implication. That's hugely difficult. And you were mentioning the amount of money we spend on reporting, but not only money and people are used to deal with these issues. Basically, in the end, you end up in a large group to have people dealing more of that type of things rather than to do real business. And at a certain point, you have to look at the balance.
And do you expect are the Germans going to follow suit and do the same thing, or the French? French need to improve their tax revenue right now. I'm sure they can look at all those French citizens in London today.
Well, I just can't say on this one. I just can't say, sorry.
Okay, well, I will turn the question then to something else, which is another question from the audience. And the question is, why in the panel are there only women? Is regulatory and rating a female specialization?
Nobody's perfect, with this woman.
Well, I think a male producer had an interesting idea and imposed it on all of us.
Yes, well, I think it's an interesting issue because, of course, the regulatory sector is the one sphere of finance where there actually is a significant representation of women. Elsewhere, in many other parts of the financial industry, the gender balance is less equal, one might say. But in light of that, it's interesting to turn to the next question that I'm going to ask the audience, which is this. First of all, the simple question, for those of you who can't read, are you male or female? 1 for male, 2 for female. If you can vote now, we can quickly see our own gender balance. I would guess it's probably not the same as the panel. Right, shocking surprise. 75%, 74% male. Okay, right. The next question is, do you think that if there were more senior women in banking today, would the turmoil of the last 5 years and the reaction to it have been any different? If we'd had Lehman sisters, not Lehman brothers, would we be living in a different world today? This is really truly a question to guarantee that you're all awake after the previous discussion of Dodd-Frank. So go ahead and vote. Right, now I think we should have a breakdown of men versus women on this, which is, gosh, well that is interesting. That speaks for itself. That's very interesting indeed. Well, do those results surprise any of you? Because I say what's fascinating, I've never actually sat on a panel before which is all female at a financial conference. I'm used to being the token woman. I'm used to certainly being the token woman on the TV set because I always know I'm sandwiched between two men usually. But I mean, any of you got any views on whether this is simply a distraction or an interesting issue to talk about?
I think that having more diversity in the workplace is a fantastic thing. There's a lot of research out there that says that having women in the boardroom, women in senior management positions, results in some decision-making that's certainly different. Women have a different management style. There's more inclusiveness in decision-making, according to research. There's also willingness to adopt diverging opinions. These are things that can change the outcome of decisions, and I think that's a good thing.
Well, more than maybe a gender, I think that you rightly point out the notion of diversity. And I must say, when I joined Deutsche Bank and the Group Executive Committee, I had a lot of questions from journalists because I was the first woman to join the board.
You were the first woman to join the executive board?
Right.
In the whole of Deutsche Bank's history or just at present?
The first woman in the whole Deutsche Bank history, I guess.
Well, congratulations.
Sorry about that. No. But then I answer, it's not the point about being a woman, but being from, I was the
Were you the first non-German to join the board?
Not at all. That's what I'm going to. In fact, I was the first French. And I say, well, what is important is to be from a European, continental European base. And clearly what is very interesting in that bank is the diversity. I mean, within the Group Executive Committee, you do have a lot of nationality. And again, that's very important. It's not only the gender diversity, but the diversity of culture, which provides different point of view, different way of looking at things. And clearly, I guess that diversity is very a good point. Not only gender, but global diversity.
Annette, I'd like to ask you, why do you think you have so many more female regulators than female traders, for example? Because if you look back at the history of, Washington regulatory structures or New York regulatory structures, there's quite a discrepancy between what's happening in terms of the gamekeeper rather than the poachers.
Well, there are probably a number of reasons for that. I think that there's more of an emphasis on diversity in government than perhaps in the private sector. I think the government has been sort of in the forefront of focusing on those issues. I've always thought, having worked on Wall Street myself, that the real test of whether people are committed to diversity is whether they'll give you part of the piggy bank to play with. I was the first woman partner at a small brokerage firm in the early 80s, the first in 100 years, but they had never made a woman and never made a woman partner who traded. And so, you can sort of be flattered and on the other hand realize that there's a dichotomy between, the opportunities that women have had in some areas versus others. So I think the real test will be if, when you see more women actually on the trading side.
Right. What about you, Barbara? Because, of course, on the buy side, there has historically been a slightly higher proportion of women. Do you think that women have a different style from men and the crisis would have been any different if it had been a primarily female-dominated industry? Would we have less hubris at the head of some of the big asset management firms?
Well, first of all, the asset management firms were not particularly involved in the crisis. It was a banking crisis. So let me start with that. In terms of buy side versus sell side, you have very different cultures. The buy side culture is a fiduciary culture. Probably, you can't say no hubris, but certainly less than what we've seen in this banking crisis. And you also see many more women in positions, whether it's at the foundations and endowments, the CIO level, or at pension plans. You also see in a number of firms in senior management. I was a founder of BlackRock. There were 2 women out of 8 in 1988. That was considered very unusual. You look around the industry today, you've got a woman heading asset management at JP Morgan. You have a number of women who own their own firms in the hedge fund space. So it's changed a lot over the last 25 years, and there's always room for improvement. I would echo diversity of all sorts, whether it's cultural, nationalities, gender. There's a lot of different kinds of diversity. I think it leads to better decision making and better outcomes. But I wouldn't go anywhere near this question.
Okay, well, listen, I'm going to ask then one other quick question, because we haven't got much more time, and I have one more audience poll to do. Last question to the audience. We've got 5 minutes to go, which is to go back to the question we asked this time last year on this panel, which is there a high risk of another financial crisis? Is there a high risk of another financial crisis? And I'm going to impose a sort of time frame for this because, if we say is there a high risk of another financial crisis in the next 1,000 years, that's obvious. But let's say, do we think there's another high risk of another financial crisis, say, in the next 15 to 20 years? So do we think the regulations have prevented the risk of a financial crisis or not? Should we say yes or no? 1 for yes, 2 for no. Right, so almost exactly the same, in fact, slightly higher than last year in terms of the answers. Any thoughts on that? Do you think that there is a risk of another financial crisis soon? And
well, soon, no, soon. But the economy works in cycles. So clearly you have up and down. So we cannot think that we're going to escape from any financial crisis and go out of any financial cycle. That's not possible. What we can hope that basically we will handle it better than we did in the past, and that clearly that the risk will be covered by adequate protection, let's say capital or whatever. So that's clearly what the objective is, not to try to have the economy being flat, because otherwise it's not, you would not have growth. That's the situation where in some country we are right now. So, economy is a cycle. You will have financial crisis. What we hope is that the regulation help to have the major intermediaries be safer and be able to handle it better than it did in the past.
right. Elizabeth.
It's very interesting. You have to ask, where is the financial crisis going to come from? And in general, you always think of a liquidity crisis as the heart of the issue, but you also think always of lending. And I certainly would not be sanguine that another one would not occur. And if I look at some of the indicators that are out there that would lead you to think there could be another financial crisis, I'd look to something of a credit bubble that's starting to develop, probably not driven by the banking industry, but more so by other actors outside of the regulated banking entities. And you see a lot of purchasing of loans taking place, for example, in the pension sector. So what we want to do is look to some of these areas and make sure that
So it's like people like BlackRock buying leveraged loans. Is that what worries you?
No, BlackRock doesn't worry me at all.
Sorry, are you worried about, say, buying leveraged loans? Is that kind of thing that of
Commercial
concern,
real
or?
estate, leverage lending, these are pockets of areas that have perked regulatory interest, and properly so.
Right. What about you?
Well, I think we'll always have, some financial crises and corrections. I think the hope is that with the regulations that we have, that you'll dampen the effects somewhat, and we have to hope that's the case. Although, as I said earlier, because regulation itself is episodic, you have to hope that you're not experiencing a financial crisis when you've lifted some of
Right.
the regulations that might have helped.
And Barbara, are you telling BlackRock's clients that there's likely to be another financial crisis at some point, or do you think the outlook looks fairly calm in terms of what it means for them with their money? Do you think regulators have actually fixed the problems?
So I think there's a fundamental difference between a crisis like what we saw and a cycle. So a market cycle, even something like the internet bubble, it happened, it wasn't a crisis. You could have a credit bubble that can happen, it's not a crisis. Almost every financial failure, if you go back in history, is related to leverage. Long-term capital, Lehman Brothers, Merrill's problems, everyone right across the board, they have a liquidity crisis. Even if they're solvent, they can't roll over their commercial paper, they can't stay in business. And then there's this systemic run-on. That's what regulators should be, and rightly so have been, focused on. The idea of pension funds buying leverage loans, that won't lead to a crisis. The pension fund might have a loss, there's no crisis. So I think we need to separate the idea of markets go up and down. There are cycles in regulatory reform, there are cycles in banking. There are all different kinds of cycles. Cycles are not the same as crises. Leverage leads to crisis.
Right. Well, that seems like a good moment to wrap up on. I mean, having heard the discussion, I would have 3 key takeaways. One is that the current trends aren't about to be rolled back anytime soon. I think it's fascinating that none of you are predicting an end to the enforcement actions, and you all seem to think that what's on the table in terms of the regulations is what we're working with. Secondly, it's clear that regulation is being taken very seriously at all levels of the private sector firms, and that's certainly a change. But thirdly, what I do find somewhat dismaying is that when it comes to coordination and trying to fine-tune the regulations and the regulatory outlook, it doesn't sound like you're terribly optimistic as a group that rationality or efficiency is going to triumph anytime soon. So I guess the one clearest conclusion of all is that the lawyers will be very busy for the years to come. So thank you all very much indeed for taking part. Fascinating debate. Thank you to the audience for organising, for taking part in the polls. And best of luck to all of you in figuring out the answers. So thank you.
Thank you.